mentioned, my name's Stan. I work for Plus Accounting. We're a firm of chartered accountants situated in Brighton, just down by Preston Park, if any of you know the area. Um, we specialize in all areas of accounting, tax, and audit. So that varies completely because there's so many services that we offer. We have a range of different clients, ranging from small self-employed clients to large limited companies. Today I'm going to be running you through the basics of self-employment for startups. So what we will be covering today is trading statuses. So I'll run you through all of the different trading statuses, but the main ones I'll be talking about are self-employment, limited companies, and community interest companies. We'll also be talking about record keeping, what expenses can be claimed, limited company salary versus dividends, and then VAT registration. So I prepared slides on all of these topics. What I'll do is I'll run us through them, and then at the end, we'll pause the presentation and I'll take any questions that you have, either relating to these specific topics, or if you have anything else regarding self-employment or accounting, you can ask me that as well. What we'll do is we'll get through the slides first, and then at the end, I'll take any questions that you have. So as we're working through, if anything arises, if you just jot it down, you can ask me at once we've been through the slides. So let's get into it. So what we'll do is we'll start with the different trading statuses just to set the scene. So the main business structures are sole traders or self-employment, which we'll come on to in a bit more detail in a second, partnerships, limited liability partnerships, private limited companies, which either be limited by shares or limited by guarantee, community interest companies, and charities. So this note here at the bottom is important because there is actually no recognized legal structure as not-for-profit. So if you wanted to run a not-for-profit, you would have to be recognized as one of these structures above. So you can have a not-for-profit charity or a not-for-profit community interest company, but you couldn't just have a not-for-profit. It has to be one of these structures. So the first structure that we'll look at in a bit more detail is a sole trader. So what is a sole trader? A sole trader is essentially a business that is run by an individual where the individual and the business are not separate legal entities. So essentially the individual is the business itself. If you're working for yourself as a sole trader, you need to inform HMRC within 3 months of starting to trade. So if this is something that you're looking to get into, as soon as you decide that you want to start trading, you just need to remember that you must inform HMRC. Once you do inform them, they'll issue you with a 10-digit unique tax reference or UTR. Once they've issued you with your UTR, you'll keep that throughout your whole sole trade career. It won't change or anything like that. You'll have the same 10-digit code throughout. Once you've got that, you can then set up a government gateway. So this is your portal to HMRC for self-assessment. So it will include all of your self-assessment details, so your self-assessment tax return, your UTR, any other details that you need to get access to. Once you've got all of that set up, you can then start trading. And once you start trading, you'll need to record your income and expenses. And the majority of sole traders do this to the 31st of March each year because that ties in with the tax year end. So each tax year in the UK, it ends on the 5th of April. So having your records go up to the 31st of March just makes it easier because it ties in with that tax year end. If your turnover is under £150,000, which for most sole traders it is, you can use the cash basis, which basically means that you can record your income when you actually receive it into the bank account and your expenses when they're actually paid out of the bank account. So it just makes it a bit simpler. And then once you've got your records all complete, you've recorded the transactions, your income and your expenses, you then need to complete a personal tax return. And that basically needs to be completed anytime between 6th of April, so the day after the tax year ends, and 31st of January. So for the current tax year, which is a good example because we're almost there now, if your accounting records went to the end of March 2025, they would then be reported on your self-assessment tax return for the year to 5th of April 2025. And then you'd have to file a self-assessment for that year from any time from the 6th of April 2025 to the end of January 26. So that's kind of what you need to do to get set up and what records you need to keep. And then we'll get onto a bit more detail here on what you can earn and what kind of the tax rates are. So anyone can earn up to £12,570 tax-free. And that's basically because everyone has a personal allowance, and a personal allowance as I mentioned, is £12,570, and that is basically the amount that anyone can earn before they start paying any income tax. As soon as your income goes above £12,570, you start to pay some income tax. So if your income is between £12,570 and 50,270, you pay basic rate tax at 20%. So that isn't on your whole lot. So you don't lose the tax-free section when your income tips over. You still get that first £12,570 at essentially 0%, but it's the bit between 12,570 and 50,270 that is taxed at 20%. So you get the first at zero and then that second portion at 20%. As soon as your profits go above 50,270, you start to pay tax at 40%. But again, it's not 40% on everything that you've earned. It's only the bit above the 50,270. So essentially, if your income was above that, you could have three different tax rates. You'd have the first part 0%, the next part 20%, and then the part after that at 40%. So that's basically how the income tax works on sole trade profits. You also have to pay national insurance if you're a sole trader. So if Class 2 national insurance is applicable, that's £3.50 per week. So Class 4 national insurance will always be applicable if your profits are in excess of 12,570, which is the same rate as the personal allowance. So that's at 6% on profits over 12,570. And that again goes to the same level as the income tax up to 50,270. So once you get to that level, you then start paying 2%. So that's basically how the income tax works. So when you do your self-assessment tax return, you'll calculate your profits, you'll then calculate your tax liability based on these rates and allowances here, and then you'd calculate your national insurance liability. You then add them both together, and that would be the amount that would be due to HMRC for that tax year based on the profits that you've earned. Also, just a final point on the sole traders. If your tax is over £1,000, so that's the liability like I just mentioned, then you do have to pay payments on account. And basically, what that means is you have to pay a payment on account towards the following year. So in your first year of trade, you have to pay the full amount for the year that's just passed, but you'd also have to pay on account for the year after. And HMRC do that just so they can collect the tax in advance of when it's due. So you'd have to pay 50% of the balance when you pay for last year, and then another 50% on the 31st of July. So that's basically covering the basics of a sole trader. And I'll take any questions that you have on that when we get through the slides. So next, what is a limited company? So the key difference between self-employment and a limited company is that a limited company is a separate legal entity to you. So where I mentioned that a self-employed company or sole trader, there's no distinction. You are the company, you are the business. If you have a limited company, it is a separate legal entity. So the company makes sales, incurs expenses, and makes profit that are subject to corporation tax. And also the company has limited liability. So this is the difference between a sole trade and a limited company. You have to incorporate a limited company at Companies House. So there's basically a form that has to be completed in order to incorporate the company. Once that's done, Companies House will issue you with a company authentication code. And like your UTR, that is a unique code and that will be unique to the company. Companies House will then inform HMRC that you've incorporated a limited company, and then they'll issue a 10-digit unique tax reference number. So it could be the case that you have a 10-digit UTR for your limited company and also a 10-digit UTR for you as an individual. So you could have two, one for the company, one for you as an individual. So companies have managers, which we call directors, and owners, which we call shareholders. So if you have a limited company, you record the income and expenses according to your company financial year, which can be any month end of the year. So our clients have a variety of year ends spanning the whole way throughout the year. So whereas if you're a sole trader, you do it in line with the tax year. So you'd have a 31st of March year end. Limited companies can have any year end throughout the year. So you'd work out your income and expenses. Accounts would be prepared to your year end, and then they'd need to be submitted to Companies House annually. So the submission deadline is 9 months after the company year end. So if you had the 31st of March 2025 year end, the accounts would be due to be filed at Companies House by 31st of December 2025. And then they'd go on to the Companies House website, which is available to the public. Limited companies also have to file corporation tax returns. So once the account's been prepared, the corporation tax return would then be prepared. The corporation tax liability would be calculated. That would then be submitted through to HMRC. The submission deadline is 12 months after the company year end, but this is something to be careful of. The payment deadline is 9 months and 1 day after the company year end. So the date that the payment is due is actually before the submission deadline. So sometimes if the return isn't due, companies have to make the payment and then they'll submit the return later on. So again, using the same example, if a company had a March year end, their return would be due by the following March, but the payment would be due by the 1st of January. So you can see there the payment is due before the return. If a company makes £1 of profit, it'll be taxed on that profit. So whereas when I was talking about the sole traders, I mentioned that every individual has a personal allowance of £12,570. So you can earn up to that amount before you start paying any tax. But limited companies don't have the same allowance. So even if it earns £1, it will pay tax on that £1 of profit. There's no allowance there at all. So here are the rates. Profits of £50,000 or less are taxed at 19%, which is what we call the lower profit rate. Profit of £250,000 or more is taxed at 25%, which is the main rate of corporation tax. And profits between the two are taxed at 25%, so the main rate less marginal rate relief. When we're calculating the corporation tax, we also have to factor in associated companies, and that's just basically if someone has more than one company and they're associated, these thresholds that I've mentioned here are adjusted. So you pay personal tax on any money withdrawn from the company. So what happens is the company makes a profit, the company pays corporation tax on that profit, and then you also pay some personal tax if you withdraw the profits from the company. So the withdrawals can be in the form of salaries or dividends. So it's basically a two-step process. The company earns the money, and then to pay it out to yourself as an individual, you either have to pay it as a salary from the company or as a dividend from the company if you're a shareholder. Whereas if you're a sole trader, whatever you earn is essentially just yours because you are the business, you've made the money. Even if you don't withdraw it, you're still taxed on whatever the profits are. Whereas if you have a limited company, the limited company is taxed on whatever profit is made, but you as an individual will only be taxed if you actually withdraw anything from the limited company. So if you earned a profit in the company but didn't withdraw anything, the company would pay corporation tax, but you wouldn't pay any personal tax because you haven't actually withdrawn anything. So it's only if you do, then you then trigger a personal tax liability. But as mentioned, you would withdraw funds from the limited company in the form of salary or dividends. So that's kind of an overview on a limited company. There's quite a lot of information there. So if anyone's got any questions, just jot them down and we'll come back to those once we've got through all of the slides. Okay, so this is the last structure that we'll be talking about in detail. So this is on community interest companies. So a community interest company is a separate legal entity to you, a bit like a limited company. Again, it makes sales, incurs expenses, and makes profit that is subject to corporation tax, just like we saw on the last slide. So a CIC is a special type of limited company which exists to benefit the community rather than the shareholders. So with a limited company, it usually exists just to benefit the shareholders, so to make a profit and distribute that out to the shareholders. But with a CIC, it basically exists to benefit the community instead. To set up a CIC, you need a community interest statement. And basically what the interest statement does is it explains the business plans, it explains how the company will actually benefit the company, kind of what the structure will be, what you're planning to do, what activities will be carried out. CICs need an asset lock, which is essentially a legal promise that the assets will only be used for social objectives, and limits are set on what money can be paid to the shareholders. So that's basically in place to stop someone setting up a community interest company it's supposed to be there to benefit the community, but then it makes a profit, which is all then paid out to the shareholders rather than used for the purpose that was stated in the community interest statement. CICs must be approved by the community interest regulator, so the application will be automatically sent to them. once you apply, and then they'll review it and come back with any queries, or they'll accept the application. As with limited companies, CICs are registered at Companies House and submit annual accounts. Setting up a CIC is a big step, as once registered, the only way out is to dissolve or to convert into a charitable incorporated organization. So when you're setting up a CIC, you need to be sure that it's the structure that you want to go with, because as mentioned, the only way out is to convert into a CIO. A CIC must either be a company limited by shares or a company limited by guarantee. So if it's limited by shares, you have shareholders and dividends can be paid out. But if it's limited by guarantee, that isn't the case. If it is limited by guarantee, there is a dividend cap, which is no more than 35% of the CIC's profits. So that's similar to the asset lock that I just mentioned. That's in place to stop someone running a CIC, saying it's for the benefit of the community, and then paying out all of the profits to its shareholders. So that's why that cap of 35% is in place. If a CIC makes profit or pay corporation tax, just as I explained with the limited company, exactly the same applies. And again, you pay personal tax on any money withdrawn from the company, either in the form of salary or dividends. So again, that's exactly the same as I explained on the last slide. So moving on. Okay, so they're the three trading statuses that I just wanted to go into in a bit more detail. And you may be thinking, what do you need to consider in order to decide what trading status is best for you? So here are the key considerations. So I'll just run through them. So the first one is your level of profits. So if you have a low level of profits, you may feel that it's worth just being a sole trader, because if you have a small amount of profits, you may think it's not worth going through the process of incorporating a limited company, having to be registered at Companies House, having to prepare accounts, let you filed, having to prepare a corporation tax return. So just for simplicity, it may be worth just remaining as a sole trader. Your other source of income, because this links how business income is taxed. So if you have other sources, it may be that you'd rather have a limited company. So the limited company is taxed on the profits, and if you don't withdraw them, you wouldn't be taxed personally. Raising finance, it can often be easier to raise finance if you run a limited company. So sometimes we find that sole traders struggle to raise finance, but if they were to be a limited company, that process might be slightly easier. Profit extraction. So that's basically referring to how you extract profit from the company, which is what I explained previously regarding the salary and dividends. So that's a consideration you need to make. The level of compliance. So level of compliance for sole traders is less than it is for limited companies and CICs, because if you have a limited company, you need to prepare accounts which are filed at Companies House and then go onto the public record. You also have to prepare the corporation tax return that needs to be filed with HMRC and then pay the corporation tax over. Whereas if you're a sole trader, you just need to prepare and file your self-assessment tax return each year. Professional fees is another consideration because of the higher level of work that's involved with running a limited company. The professional fees are also higher because the accountant would have to prepare the accounts, which include various disclosures and wording as well. The accounts would then need to be filed, and they'd also have to prepare the corporation tax return, calculate the liability, and then file that as well. Whereas if you're a sole trader, you'd only have to pay someone to file your self-assessment tax return, which would come at a cheaper fee. And then the final point I've got here is the perception of others. So often, if you want to look to your clients like your large business, it's often better to be a limited company. Um, Sometimes it's just perceived to be kind of a more professional structure rather than being a sole trader, but that isn't always the case. So they're the considerations that you'd make when deciding what status you want to trade as. Okay, so let's move on to record keeping and what the legal requirements are. So often when people start businesses, it can be quite overwhelming. It's hard to know what documentation and what records you need to actually keep. So what I'll do is I'll run through the main documents that must be retained on an ongoing basis. So businesses are legally required to keep records of their business transactions for the current year and the previous 6 years. So once the records are more than 6 years old, you can discard them. You don't need to keep retaining those. So it's only for the current and the previous 6 years. The records can be kept as hard or soft copies, but must be legible and accessible. So that basically means that you don't have to print everything off. and keep it in boxes or keep all of your actual physical receipts. You can have digital copies of everything. So these days, a lot of our clients, they won't have any paper records at all. Even if they have a receipt, they'll scan it into their software. Or if they get something through to the email, they'll just save it in a folder on their computer or on their software rather than printing it out and keeping it in a physical folder. It's just a bit easier to store that way. Um, the record you'll need to keep. So this isn't a complete list, but this covers basically the majority of what you do need to keep. So all of the records on financial transactions, so anything on your sales, so sales invoices, any expenditure, so purchase invoices, purchase receipts, your bank statements, and also your credit card statements if you have a credit card. You'll need any supporting paperwork relating to lease agreements. So that may be a rental lease, hire purchase agreements if you've bought any assets on hire purchase, and any loan arrangements if you've taken any loans. If you have a payroll scheme set up, either for yourself or if you have any staff, you'll need to keep all of your payroll records. If you have a limited company and you're paying dividends, you'll need to keep dividend vouchers and meeting minutes, which basically just provide details of the dividends that have been voted and paid. You have to keep copies of any business plans, budgets, forecasts, directors and shareholders agreements, and any correspondence from Companies House and HMRC. So that's the majority of what you'd have to keep. Okay, onto the record keeping. So these days, a lot of our clients they use a cloud-based system to maintain their records, just because there's a sophisticated system and it makes keeping your records a lot simpler and more efficient. You can use Excel, as mentioned here. If your transactions are on kind of a lower scale, you could use Excel and just keep a spreadsheet to monitor your incomings and your outgoings. But on cloud-based systems, there's various other features. So, for example, a lot of our clients use Zero, and what Zero does is it allows you to upload all of your invoices and your receipts. So instead of having to keep them in a folder on your computer, or a file, if you keep physical copies, you can just upload them into the Zero accounting system, and then you can basically match them against your invoices so everything is in the system. And if you ever need to obtain any records, everything is in one place. Also, with the cloud-based systems, they all link to bank accounts automatically. So rather than you having to go onto your banking system, look at what's come into the bank and look at what you've spent, you can simply just go onto your accounting system. It would have imported all of the transactions automatically, and then you can just go through and reconcile them against any sales invoices and purchase invoices. So it's just a more efficient way of doing things. But if your transactions are on a smaller scale, you may find that Excel is sufficient. It's only when the business gets larger that you would need to move over to a cloud-based system. So it does vary. There's many kind of factors that play into it. So you'd have to kind of look through the different systems and work out what's comfortable to you. But your choice may also be influenced by the business requirements. So as mentioned, the systems all kind of have different features. A lot of them also have the ability to file VAT returns as well. So all the ones mentioned here, Zero, Sage, QuickBooks, they'll also all have a VAT return feature. So if the business is VAT registered, you could use the system that you're doing your bookkeeping in to prepare the VAT returns, and you'd also actually be able to file the VAT returns to HMRC through the system. So that's another consideration. So, what are the benefits of actually keeping a well-maintained system and kind of keeping all your accounting records summarized and in one place? There's quicker conversion of money owed by customers into cash because it just allows you to keep track of who owes you money, who's paid you, who hasn't paid you. Because if you don't have any records, it can sometimes be difficult to work out if you've billed someone, have they paid you yet? Have they not paid you? So having a system in place where it's all well organized and you've matched the receipts against the invoices just allows you to keep track of that. Better tracking of expenses, allowing for better cash management. Again, on these accounting softwares, you can easily run reports to see what you've spent on each category, and it just allows you to keep track of what's being spent, if you're over your kind of estimates or your budgets, if you're under, and just allows you to plan for the future. Whereas if you're just paying stuff out of a bank account without really maintaining it, without going back through and summarizing everything yourself, it can be difficult to work out what you've spent and if you need to cut down or if you've kind of got a spare that you can spend or you're not spending enough on marketing. It just allows you to kind of look at the trends and plan for the future. You have real-time access to account balances, including credit cards and bank accounts. So that's what I mentioned on the last slide. The softwares have an automatic link into the bank accounts. So instead of having to log into your banking to see what's come in and what's been spent, it automatically feeds through into the accounting system. Ability to plan ahead. So you can estimate your corporation tax due on profits and what dividend could be voted. If you aren't keeping your records, it can be difficult to work out what your year-to-date profit is. So it's more difficult to plan. But if you have a system in place, that kind of just eases that and allows you to look to the future. Better understanding of your business finances, because again, you can see um, what your income is, what you're spending money on, that sort of thing. Readily available customer and supplier records. So again, these accounting systems allow you to kind of maintain all of your customer and supplier information within one system. So if you ever need to access that, you can easily just go into their record and find whatever details you need to find. Better customer and supplier relationships. Again, that's just because you can ensure that you're paying your suppliers on time because you have a track of who you owe money to. You can easily see kind of what you've billed to your customers and if they've paid you, so you're not chasing money when it's already been paid. And then finally, there's a retention of financial history and records. So as I mentioned, everything essentially gets uploaded into the system. So you know that everything's there. It's not in multiple places. So if you ever need it, you know exactly where you can find it. So they're the main benefits of kind of maintaining an accounting system. Okay, so this is another main topic when someone starts a business. One of their main questions is what expenses can they claim? So HMRC's guidance states that business expenses must be wholly and exclusively for business use, which basically means that the expense must relate solely to the business and what you're doing within the business. So all day-to-day running expenses can be claimed. These include telephone costs. If you run a limited company, the mobile phone contract must be in a business name, so that's a consideration. Any advertising costs, traveling costs, but not commuting to a permanent place of work. So if you have an office that you travel to every day, if you're traveling to and from that office, you cannot claim those traveling costs, but the costs you can claim if you're going to meetings or going to see clients or traveling out to site, that sort of thing. And claim your business insurance, accountancy fees, and any other professional fees that relate to the business, computer expenses, salary, bank charges. So that's not a complete list, but they're the main kind of costs that you'd incur. Working from home costs as well, you can claim. So if you work at home, so if you don't actually have an office, you can make a claim to basically claim a proportion of your household expenses. So there's two different methods there, a simple method and a complex method. Equipment that would be used within the business for more than a year. So computers, laptops, work mobile phones, that sort of thing. Some expenses may be a benefit in kind, such as if you have a company car that you use personally, or the business pays for medical insurance for you as an individual. Benefit in kind may arise. If you're ever in doubt with what you can claim and what you can't claim, it's worth asking your accountant rather than going ahead and then finding out at your year end that you couldn't have claimed it. It's always worth checking with your accountant if it is an allowable expense and it is something that the business can incur expenditure on. Okay, so this slide goes into extracting money from a limited company in a bit more detail. So I mentioned previously that if you're extracting money from a limited company, you can either do that by paying yourself a salary or by paying dividends. So this first slide covers what you'd do if you were to pay yourself a salary from your limited company, or if you're taking on an employee. So if you're paying yourself a salary or an employee of the company a salary, you'll need to register for PAYE and must do so before the first payday. So as soon as you know you're going to pay yourself or you're going to pay an employee, you must register with HMRC. You can either do that online or by the telephone. So the most important matters to consider with regard to PAYE and taking on employees are the level of pay, the hours, having a contract in place. If you have employees, you'll need to get a contract in place. The legal obligations of having an employee, which include health and safety, minimum wage. So you need to ensure that they're getting paid the minimum wage, which can change. So it's worth checking what that is if you are to take on an employee. Auto enrollment and pensions. So there's an auto enrollment scheme, and if various criteria are met, then you must offer an auto enrollment pension scheme to your employee. Payroll will need to be processed, and submissions will need to be made to HMRC on a monthly basis. So often people use a payroll provider to do that for them. So you provide the detail to the payroll provider on a monthly basis, and they'd prepare and file the reports for you. Appreciating the impact on cash flow and profitability. So of course, if you're having to pay yourself or someone a salary, you'll need to pay that out of the company's bank balance, and also it will reduce the profits of the company. So the salary, the employer national insurance, and employer pension contributions, if there are any, are all tax deductible expenses for a company, meaning that they reduce the company's profit and therefore reduce the corporation tax liability. And then here are the tax rates on the salary, which are the same as what they were on the sole trade profits that we discussed earlier. So it's 0% in the personal allowance, which, as I mentioned, was up to £12,570, 20% in the basic rate, 40% in the high rate band, and then 45% in the additional rate band. So they're exactly the same as what they were for the sole trade profits. You can operate payroll yourself via HMRC's online software or other available accounting software. But as mentioned, a lot of our clients do tend to use an external payroll provider just because they're trained in the area and they know exactly what they're doing. And again, it's recommended that you seek professional advice if this is something that you're looking to do. So now on to dividends. So obviously I mentioned you can either pay salary or dividends. So this kind of goes into a bit more detail about how dividends work. So one of the advantages of setting up the limited company is the ability to pay the shareholders dividends. One of the key differences is a salary is a tax deductible expense for the company. So the company can offset the salaries that it's paid off its profits before the corporation tax is calculated, but dividends are distributions after tax. So essentially the company's profit is taxed and corporation tax is paid before dividends are distributed. So dividends don't reduce the company profits and don't reduce the corporation tax liability. Dividends can only be paid if there is sufficient company profit available. So if the company hasn't made a profit, doesn't have sufficient profits available, you can't pay a dividend out. So essentially, you can only pay it if the company is profitable and the reserves are available. Dividends are declared on your personal tax return and are taxed at the following rates. So the first £500 of dividends that you receive is tax-free because everyone has a dividend allowance. 0% if they fall into your personal allowance. If you have no other income that's already used that allowance, your dividend income can use that. So that's up to 12,570. Then the rate goes to 8.75% in the basic rate band, 33.75% in the high rate band, and 39.35% if they fall into the additional rate band. So this is one of the key differences between salary and dividends, is that dividends are not liable to national insurance contributions. So previously I mentioned that a salary would be liable to national insurance, as with the sole trade profits, but with dividends, there's no national insurance contributions due. There are optimal levels of salary and dividend that you can pay. A lot of our clients are kind of on similar structures because it's the most tax efficient way of doing things. So if this structure is something that interests you, it's worth speaking to your accountant just to get that optimal structure in place. Okay, so we're on to the VAT registration now. So we're almost at the end, and then I'll take some questions. I appreciate that there's a lot of content there, but we're almost there. So VAT registration thresholds and requirements. The compulsory VAT registration threshold is £90,000. So this basically means that once a company's turnover exceeds £90,000 over in a rolling 12-month period or in the next 30 days, a company must register for VAT. So if your turnover exceeds £90,000 in a 12-month period, you have 30 days of the end of the month in which you need, if you literally went over the threshold to register. Whereas if it was in the next 30 days, you have to register for VAT by the end of that 30-day period. And it's just a little example there, which states the dates. Once you've registered for VAT, so once you've applied, HMRC have accepted the application, and you've got your VAT registration date, you must charge VAT on all sales at the appropriate VAT rate. The standard rate is 20%, but there are some other rates depending on what the services are. And you also need to complete online VAT returns, which are normally quarterly. So this is when the online bookkeeping system really comes into play, because you can use the online system to keep your books, prepare the VAT returns, and then file them with HMRC. There are different VAT schemes available, such as the flat rate scheme, where you pay a lower percentage to HMRC, but you cannot recover VAT on any of your business purchases. So whereas under the standard scheme, you can recover VAT on any purchases where you've been charged VAT. If you're on the flat rate scheme, you cannot do that. And then since April 22, all businesses have to file their VAT returns digitally using Making Tax Digital. So all of the softwares I mentioned previously are Making Tax Digital compliant. So you can use those to file your VAT returns. Okay, so that's everything from me on the slides. There was a lot of content there, so I assume that some of you have some questions. Hopefully, I didn't go through it too fast and it was kind of at a manageable pace. But I just thought it would be useful to give you as much information in the time that we have available. And as mentioned, this will be uploaded to YouTube. So if you need to go back through any of the slides and pause it and take notes and that sort of thing, you will be able to do so.